Hi, everybody. I'm Anthony Lopez with Century 21 New Beginnings, and today I have my preferred lender, Jose Treto of Guarantee Financial.
What's going on, guys?
Tight.
That's so funny you said that, and you said my last name in Spanish. I feel like it's a lot easier
It's
to
because
roll
we
off
have a bilingual, we have a multicultural viewing audience right
Oh,
now.
there you go. No, but
in case
really, how clutch is it when your client asks you, "Oh, do you speak Spanish?" And then you hit them with a "Sí, cómo
Sí,
te
¿cómo
ayudar?"
estás? Whatever. Anyways,
What's up, guys?
So we wanted to go and talk to the reason we wanted to do this podcast today is because there's a lot of things going on out there, a lot of uncertainties and a lot of expectations that people have, especially when it comes to financing. And one of the biggest things that I've come across is some clients need to be super transparent with what their finances look at, and the only way to do that is if you, of course, again, you have to be super truthful. And we can get to the closing table because a lot of times, what happens is that they believe, oh, I got the documents, I got a pre-approval, and this is all I need. Why can't I buy this house? So there's a lot of back end into this, and I think that the expectations are set high, and what they do is they'll blame the lender that it's their fault for not closing when it all has to be done. It all has to do with being transparent with it.
Yeah, and I tell all my clients, it starts. The process is simple, right, from start to end, but it truly starts with the pre-qualification and the pre-approval process. The pre-approval process is pretty much where you're going to get all the information, and a lot of times clients are afraid of that stage because that's when they start to pull back the curtain of what's really going on with their financial situation.
So no more hiding.
But it is scary, and especially for a first-time home buyer, you got all this information on social media. You got your tias and tios telling you how they bought in '95 and it was a little bit different. So it is scary, and that's kind of where we come in and we guide them through that first step, right? So the pre-qualification, we kind of ask those important questions, income, where the credit's at, when's the last time they checked their credit.
Okay.
That's the stage where I found that a lot of people are scared to tell you the truth. Right.
So why do you think is that? Is it because they feel like it's not ever going to come out, or
you know what it is, man? It's kind of how you approach that person in like the scenario that you're in, right? If you're at an open house and you start to ask those questions, 9 times out of 10 they might be pre-approved already. But if they're not, they're kind of shy and they're like they want to open up, but they don't really know you yet. So you got to get that trust going.
I understand.
Right. So actually, you're really good at that. Just kind of building that trust and then asking the questions. But you know what I mean? So when you're in that scenario, it's kind of like, all right, can I trust this guy with what I really got going on? And if so, what does he want to know that seems to be the perfect scenario, right?
So can you clarify with that, with a pre-approval, and of course, doesn't mean you're 100% approved. It means you're pre-approved based on certain conditions, correct?
Yeah. So we at Guarantee Financial like to think of it as like, all right, the pre-approval is set, but we also go a step further and do the underwritten pre-approval. Right?
Oh, so you do.
Which is we cross all our T's, check all our I's, make sure that, when the loan gets to the underwriter, we're not going to have any issues, right?
Gotcha.
So the pre-approval is, just like you said, right? Making sure the credit's good. Internally, we know what DTI is. We don't expect a first-time home buyer to fully remember all the stuff that we give them, but, we can guide them to know what it is. That DTI is going to be real important. So when a buyer's like, I'm pre-approved, now I can go start to shop for like furniture. They're going to hit up, Ashley's Furniture, and they're going to start to get, then it's like, all right, hold on. The DTI just went from 47% to 75%. You know what I mean?
Yeah.
So we know it's bad, but to them, they're like, I got this letter that says I'm pre-approved.
Exactly. It's because what they don't know is that you run the credit again before closing. Right.
And it's a soft pool. The underwriter just makes sure that they didn't go out and bought a boat, right?
Exactly.
So that's the common misconception is
I mean, it's okay to go and buy food and your necessities, but buying big ticket items, I think obviously it's going to hurt you big time.
So that's kind of what we try to guide the buyer into knowing, right? Like, hey, keep everything the same. The scenario that we have now is the scenario we're going to present. Some stuff might happen. Maybe you'll lose your job within the next couple of weeks, but we can always bounce back, get a new job, whatever the case is. And that's another thing too, right? When they trust you enough to tell you where they work, how much they make.
Absolutely.
These are all pre-qualifying questions, but until we actually verify the income, it's like,
So you know, seeing is believing,
yeah,
right?
no, for sure, yeah. What I always tell clients is there's a lot of properties that have exemptions
right. That's what we got to watch
that
out
don't
for.
always come up, right?
Yep.
So just to give you an example, I had a client send me a property and was like, "Hey, Jose, I love this property. Taxes are super cheap. Let's pull the trigger and set an offer." And I was like, "All right, cool. Let me do my due diligence. Let me pull up the tax bill, make sure your payment's going to be where you're comfortable at, right?" I pulled the tax bill. Man, taxes went from, I kid you not, from like 2,500 to about 8,500.
Why? Because you took the exemptions off,
Because we
right?
took the exemptions off. Knowing that this client is 27 years old, he's not going to qualify for a senior exemption, senior freeze, you know what I mean? So this house specifically had all those exemptions. And I told him, I was like, "Hey man, we got to remove them because they're eventually going to fall off,
Yeah,
and that payment's going to skyrocket, right?"
Yeah,
So
because and that's the realtor's job. I mean, in my experience, that's what I would do. When
yeah, no, for sure.
when I list these properties, and when I as a buyer too, as a buyer's agent, you have to look at the exemption on it, because sometimes we get excited, and I've done this when I first started, right?
Yeah.
Because I was like, oh my God, it's my first deal, it's my second deal, whatever.
Yeah.
And I look at the purchase price and I look at the market time, but I'm not watching those taxes, right?
Right.
So I made that mistake, and it can definitely kill a deal, because the homeowners on there, the senior, all these exemptions
Right.
that your client does not qualify for. Now the homeowners are qualified
Yeah,
for,
they can
but
roll
they have
that
to
in,
be in
yeah.
there for a whole year, right?
Yeah.
Okay.
And then they could apply for it, and that one's they're gonna get.
So
but-
that's just something that I kind of want to share, is that anybody watching, is that as a realtor, you want to make sure that you look at those taxes, especially if you're new, because when you're new, you're super excited. Oh my God, I got I get my first deal, big old check, So one of the things that I have encountered recently, actually in one of my deals right now, is child support.
Oh yeah.
A client with child support. How important is that for the client to let you know about the child support, and what can it do? How can it make or break the deal?
No, that's super important. Especially it's a sensitive topic to some people,
Absolutely.
but it will come up, right? Because verifying income, you see sometimes on the pay stub, child support, how much they take. So we have to treat it as another liability, right?
Okay.
So whatever you're making, but then you reduce that child support, and it's like sometimes it's even up to like hundreds of dollars that they have to pay monthly or biweekly. So we treat it as a liability, which then factors into your overall payments for the month. It is important because we have to treat it like another payment, as if you would a credit card, card payment. And sometimes if it's brand new, they might not remember, right? So child support, documents such as a court order, or
Right.
determining how much he's set to pay, because sometimes it's not even on the pay stub,
Right.
right? So
Yeah, exactly.
we
'Cause
have
I have a client. I'm not gonna say who it is, but this is the same exact scenario that I just went through, and I was hoping that, oh my God, this child, it was supposed to fall off, but
Right.
we're still in the process right now of we're in the underwriting process, and it hasn't fell off yet, because he had to go to court.
Yeah.
He had to do, get it expunged or whatever they need to do out there.
Right.
And man, I was sweating, dude. I was like, oh my God, oh my
Yeah.
God, please.
No, it happens.
And sure enough, thank the Lord, it fell off. So we're on track to close that very soon.
That's good. Yeah.
And it's it's super important that again, it goes back to being transparent with everything.
Exactly.
Self-employed employees. Have you worked with self-employed employees, and how? Because a lot of my friends that I have out there, they're self-employed. They work for a union.
Right.
They're seasonal. They're off. They're working 6 months, off 3 months, and going.
Right.
Are they able to buy a house that way?
They are, yeah. So self-employment income is a little bit different. Different than using W-2 income, right? Like if a person is hourly paid or salary paid, we know for sure they're going to make the same amount every month, right?
Okay.
So we calculate it a little bit differently. Self-employed income, 1099 income, Schedule C income, we have to take a 24-month average because it's variable, right? 9 times out of 10, it's going to be variable.
Okay.
Let's take a construction worker or a barber.
Right.
Yeah. That income every month's going to be different depending on the jobs, depending on, what's out there, if it's seasonal. So we take 24-month average. So we'll take what's reported after losses, right?
Okay.
And then we'll take that for 24 for the previous year. We'll take that for the most current year, add them up, divided by 24. That's going to give us the 24-month average. The reason we can't use what they're getting deposited into their accounts or whatever, because it's variable. It's going to go up, going to go down. So what the underwriter wants to see is, that you report income, but also that you're not on a negative decline, right?
So one of the things that I've came across is when they're union workers and they let's say they get laid off,
right,
for the winter or whatever.
Yeah, that's common. Yeah.
They're still technically employed, right?
Mm-hmm.
They're not unemployed, even though they're collecting unemployment.
Right.
They're technically employed because they're employed still by the union. Is this correct?
Correct. Yeah. So with union workers, we do ask for a union card to show that they're still, within the union. It's not expired or anything like that. Then we have a verification of employment that the, HR, whoever the case is, will fill out. Hey, he is guaranteed to go back to work starting March or whatever, right? Wherever the season starts. So then we take the average, but we also use, let's say we're already like in June or July, we'll take an average, but we'll also use the year to date, right? From March to moving forward. So it's all depending on when their season starts, what type of work it is, what union, so this happens also with teachers, right? Some teachers only get paid 9 months. Some teachers stretch out the full 12 months. So yeah, again, depending on where you work, everything's different, but we have ways to calculate it to make sure.
You're the guy to get it done, right? Yeah, there it is. Jose, I know there's a lot of, it's summertime right now, right? Yeah. So there's a lot of people going on vacation, going to concerts, buying, summer furniture.
Did you go to Sueños?
No, I did not. Okay. I fell asleep.
I didn't go yet.
And a lot of people, there's this new thing. It's called the the new age layaway. Affirm.
Yeah. The
buy now, pay later.
Right,
okay.
Right.
And it does it affect you if you're buying out? Does it go to your does it affect your DTI?
So it depends on what program you're on, because there are some 12-month payment programs that you can use buy now, pay later. But the popular ones, Klarna, Zip, or Affirm, these are pretty much increments of like 4 payments, right? Because some of them don't even verify your credit score.
No,
so it's just like the
income, right?
Pay now and then pay 4 payments. When it comes to buying a house, if we have those payments reflected on our bank statements, the underwriter is going to ask for the total balance and then ask what the payment structure is. So if it's a 4-month payment plan, chances are they're going to have us pay that at closing or pay it before closing, right? So let's say you bought concert tickets to like Lollapalooza, right?
Okay.
You only have 3 payments left.
Hold on. It's Taylor Swift, but go ahead.
Taylor Swift at Soldier Field, front row. And you have a remaining balance of like $900 or whatever the case is. On your bank statement, we've seen that you've been making payments for the last 2 months for whatever the amount is. The underwriter is going to say, hey, show me the Klarna statement showing what the remaining balance is. Pay it off at closing. Otherwise, we have to factor in that monthly payment to your DTI.
Oh, so it's going to hurt you.
It will. If you're tight on funds for closing, I would say, take that into consideration, because the underwriter will want to see you pay it off. Yeah.
Or pay it off.
It's a good option, right? But
But a lot of people don't know that it affects you. Right. It can affect you because a pay later is, everybody wants to pay later. I want it now. I want to pay you later. But so what do you do to kind of help a client out? Let's just say when they're, I know there's other programs out there right now. What are you doing to help the client out when it comes to the financial side of it?
I mean,
like, do you offer? Are you offering credits? Are you offering appraisal waivers? What are you offering for them? To anybody that's watching,
right now, what we are offering is a 1.0 buy down, which 1.0 buy down means that they have an interest rate that they qualify for. Right now, let's just use a 6.5. Right.
Okay.
Qualifying score, they're at a 6.5, but they want to have a lower monthly payment. Well, what we can do right now is give them a 1.0 buy down, which means for the first year, instead of having a 6.5, they're going to have a 5.5.
Nice.
So there's a cost associated, right? That difference in payment from a 6.5 to a 5.5 is a monthly cost. We'll take that monthly cost times 12, and we'll cover that first year for them.
Okay.
Right? So that's one way we can get them into a house.
So they might not even ever see the 6.5 because we're hoping that the rate is
right. So we give them a year's window for the rates to drop to a 5.5, 5.4, and then they might not even shoot up back to a 6.5. Or worst case scenario is rates will remain the same, then after that first year, they're at a 6.5, which they would have been
if they would have bought when they bought they would have been in the first year they had it.
Yeah, that can, I mean, depending on the loan amount, that can be anywhere from 3,500 cost that we're covering to ensure that they have a low payment that first year.
Nice.
So that you know, a lot of people are like, oh, I need down payment assistance, I need this, I need that, but there's so many ways where you can help the client and kind of teach them how to save money without having them to apply for those.
It's like that.
DPAs,
the more you know on commercial, they used to have with the star or whatever.
Yeah. Also, call us before like tax season, right? Just to make sure you're on the right track to report certain amounts. That way, it can help you buy a house. I know we don't want to pay money to the IRS sometimes, and we don't want to take that hit. So we'll report a little bit less. But if you're looking to buy a house, it's important to know kind of what's the golden number. That way you're able to qualify with the payments that
absolutely. Man, Jose, thank you so much. Man, I do appreciate your time. I know our time is limited here, so
let's do it.
I appreciate your time. We're gonna do another one. I want to thank everybody that's watching us today.
Real quick before we go, have you ever thought about doing like you know how people are starting to stream now on social media?
Yeah.
You ever thought about just doing a whole day like real life stream?
You do not want to follow.
Think about it though, showing a house, because your day is, I'm behind the desk all day, right? But you're out there,
dude, like a reality TV show.
That'll be cool.
Like what is that other one? Sunset.
Okay, well, yeah, selling sunset.
Selling sunset. Yeah. Come on, man, I'm not gonna I mean,
selling Chicago, dude. That's perfect. Yeah.
No, but I did think about that. But I mean, I get to have somebody follow me around once in a while, But anyways, I'd like to thank you again for joining me, Jose. Sure. Definitely, anybody that's watching, give us a call. If you have any financial questions or real estate questions, anything regarding real estate, give me a call and we'll put you in touch with our lender right here.
Sounds good.
Treto.
Cool.
See you guys on the next episode.